Morning, morning. Geez, it's late afternoon, early evening, Dima. How you doing tonight?
Yeah, pretty good. Well, how are you?
All right, let's start this webinar. We're starting. Thanks for joining us, everyone, for our webinar on the price distribution tool offered on MarketChameleon.com today. Dee's going to walk us through the tool. We have two people joining, both from our Zoom. We have 8 people who've checked in so far. And we're also streaming live on our YouTube channel. Anyone who doesn't know, if you subscribe to the YouTube channel, you have access to our entire webinar library. Dima, how many webinars do you think you've done?
I don't even know. Lots. I get stop counting them.
I had my 9-year-old count them today. She counted 15,000. I think she was
15,000. Yeah, that sounds right. Probably like 15,000.
It's a lot. It is a lot of information on our Market Chameleon YouTube page. Really good stuff. And with that, we have people coming in. We have on the Zoom, we have a chat function and a question and answer. Please use those to ask any questions of Dimitri. I'm going to put something in there right now. I'm going to let you know I'm from Washington Crossing, PA. Let us know that you can hear us, where you're from. You can also do that in the YouTube chat, and that on the YouTube chat, that is where you will want to ask any questions of Dimitri. D, I forget, where are you from?
Philadelphia,
PA. And behind me is the American Stock Exchange, and that's where Dimitri and I got our start. Jesus, it seems like a long time ago.
Why don't you put the Philadelphia Stock Exchange on?
Actually, you're right. That is where we officially got our start. But we started our own company on the American Stock Exchange, but we have a history on the American Stock Exchange, Philadelphia Stock Exchange, the CBOE. Am I missing any? The
Bats
Exchange. Yeah.
Yep.
All right. So we have people from California showing up. Matt from Houston can hear us. So with that, D, why don't we jump to, what do you think? The disclaimer, maybe?
Yeah, let's do the disclaimer, and then we'll get to the webinar. So before we get started, everyone, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
All right.
And with that, let me share my screen real quick. And let me know if you see my screen, Will.
It popped up.
So before here, I'm going to tell you how I got to this tool before we start. But if you're on the home page, like we are right now, if you go to the stocks and go to price action analysis, that will bring up this tool that we're going to talk about. Now, before we show some examples on this tool, let me just explain why this is important, the price return distribution tool. And it's looking from a perspective. So maybe let me start this way. There are a few things in the financial industry that you see standard uses of. It doesn't matter if it's hedge funds, banks, but professionals make use of certain tools. Now, some of them are benchmarks. We talked about how benchmarks are important. And in the financial industry, we have benchmarks, for everything. That helps us make evaluations kind of quickly. And an easy benchmark, explained to you is like, if you're out there and you wanted to buy a 2-year Toyota, well, for like, let's say $20,000. Well, you might want to look at a benchmark of, well, in the last year, what is the average price of a 2-year Toyota, with this much mileage sell for? And let's say the average is 18,000. Well, now you have a benchmark to compare it. And then you could decide, well, my car has a navigation in it or whatever. So maybe that's a fair price, or maybe you think it's not a fair price. But so that's one of the components, we talked about last week. Benchmarks are important. The other is you'll see valuation models, estimates, of what something might be worth. And, option pricing model is one example, or, theoretical value of a stock or an ETF. So pricing models become very important as well. And then this one that we'll talk about today is a statistical approach towards risk and potential outcomes. Okay, so that's another important piece of the tool that people use in a professional financial industry. So I'll give you an example here. Like you guys know, like on Robinhood, they were supposed to prevent people from buying that GME stock, GameStop.
Yep.
And they had the CEO of Robinhood come out there and explain, like, what is the deal there? Why did you have to stop? And he said, well, all it has to do, people don't understand, but there's other things going on in the clearing end, and they had to put up more money. They didn't have that much money, but how much money they got decided is based on this complicated formula. And one of them is, you'll hear like VAR. And VAR is like variance at risk. So I'll give you an example here with variance at risk. And this is what it is you'll see, it's a financial metric people use, and it's based on a statistical technique, right? And statistical techniques are also very common in the financial industry, because if you're, like, for example, option pricing models are statistical instruments. That's what they're based. You don't buy an option because of the fundamental of a company. It's a statistical instrument. And other places you're going to need those statistical instruments to help guide your decisions. So when we look at a price return distribution, for example, I'm going to leave this page right now, and I'll give you an example. What does it mean, like a price return distribution? When you're looking at an options chain, right, the option pricing model, you're looking at an options chain. Let's just put up, SPY. And when you're looking at these prices on an options chain, right, there's different months. I'm just going to go to a random month here, March 10th. So what you have here is, this is SPY, this is the expiration, and you have all these different strikes on in SPY. And the strikes are going up higher, you got strikes going lower, and each of these prices represents the probability, right? It's the probability of the stock going below this strike, if you're buying a put, probability of the stock going above this strike, if you're buying a call, and what is it worth? So this is an example. What you're looking at on an options chain is a price return distribution. That's what you're looking at converted into probabilities, right? These are probabilities and what the options we think are worth, because obviously if everybody thought that the stock is going to, like, say, exactly 400, right, then we know exactly what each of these options would be worth. But we don't know that, so these are all probabilities of all these different options being in the money, okay? So just so you guys could kind of understand. So why do we use probabilities, right? Like, why don't we just, like, use a chart, right? And a chart, for example, would be something like, here, I'll go to SPY, right? So people would use a chart, and you see, like, we rarely reference charts, just sometimes, but we rarely reference charts. But some people will use a chart and say, well, here's what the chart looks like. So if the chart looks like this, the next 5 days must be here, and the next 5 days here. But in the professional circles, we really don't use the chart that way. We'll use, like, a statistical analysis, and here, and I'll explain to you kind of like what I mean by that. A stock price is a random event, right? Tomorrow, we don't know for sure. There could be more buyers, there could be more sellers. We don't know for sure. It's just like a coin flip. And 5 days from now, nobody knows either for sure either, because it didn't happen yet, right? We don't know something that didn't happen yet. So there's no way of knowing if it's going to be up or down 5 days from now. So what do we do? And let me compare it to a roulette table. So you guys ever see a roulette table and then they give you the outcomes. Like, so here you see here on the side, well, do you see like starts from 0, then a 1 came up, 27, 26, 28, 24, 9, 7. So these, pretend that's a stock chart, right? Well, if I look at this, there's no way for me to know what the next number will be, or it'll be odd or even or red or black. I have no idea just by looking at this. So what this is telling me is it doesn't matter what the previous outcome was, what the number was previously. I can't use that 15 came out to predict the next number, right? Or that there's 26, 13, 25, and then 15 came out. I can't use that to predict the next number. It's completely random what the next number will be, right? So what do, right, if I can't do it? Well, what we call it is, what is the probability, right? That's what we're looking at. What do we think the next likely number, what do we think the odds are of them coming out? So we know here, if we look at it, we know, there's 36 numbers here and 1 green. So any one of these are 1 out of 37. That's the probability. So when you guys ever hear of, I think Warren Buffett said this, well, maybe correct me. He said that there's going to be a money panic, right? There's going to be a money panic. The thing is, I just don't know when, right? So what he's saying is that he's pricing in a probability of a money panic, that it could happen at any time. He just doesn't know when. And that's what we're looking at here at a roulette table, that one of these numbers could come out, 1, 2, or 3. Eventually it'll come out. We just don't know when. All we could do is look at what we think the probability of one coming out, right? So if we know the probability and we know the payoff, we know if it's a good deal or a bad deal. Does that make sense?
It makes sense to me, everyone. Does that make sense to you? Just put it in the chat if that makes sense so far, what Demas mentioned.
So even if I know the probability is low of the one coming out, let's say it's 1 out of 37. I have a 1 out of 37 probability that the number 1 will come out. Those are not good odds, but if somebody told me that if it does come out, you win $1 million, well, the payoff is so great, it's a good deal, right? Even though my odds of winning are not great, but the payoff is so great that if I pay $1 and I could win $1 million and I have a 1 in 37 chance, then I should be doing that bet because it's a great deal. All right. So that's what we're looking at, probabilities and payoffs, to see, are we getting a good deal or not? And that's how we use kind of like a statistical analysis. So I just wanted to kind of set it up for you before we go to the price return distribution, and let me know if you have questions coming in.
Well, everyone so far seems to be on concept, on point.
Okay. So let's just close these. And let's just start looking at price return distribution. So now this tool, what it will do is give us a return distribution and statistics based on, the inputs that we were looking for. So look, for example, let's say I'm interested in Microsoft. And I want statistics because I think, let's say my assumption is I think Microsoft will be up in the next 5 days, but I want to see a 5-day historical return distribution just to assess what do I think potentially could happen, what are my historical odds, and historical risks. Now, I showed you a roulette table, but in roulette table it's a little bit different because we already know all the outcomes, all the possibilities. In the stock, we don't know actually all the possibilities because they could be anything. So since we don't know, we use the next best thing, like an insurance company, and we look at historical outcomes as guidance. Okay, so we look at historically what tended to happen as our best guidance. So I'm going to use here Microsoft, and I'm going to say over a 5-day period, right? Because I'm interested in Microsoft for the next 5 days. Show me 4 years, 4 years of data for 5-day period on a rolling basis. I'm going to get the statistics, and then this is what I see, that over a 5-day period hold, right? So any day I bought Microsoft, sold it 5 days later, 63% of the time the stock was higher, 37% of the time it was lower. So that kind of gives me a sense of, well, it goes up more often than it goes down, right? And I know historically those probabilities now, so 1.7 times more it goes higher than it goes lower. Now, I don't know if it's going to go higher or lower. I just know, remember, we're talking about just getting a sense of probabilities. What is on average? The average move is up almost 3/4 of 1%, 0.72. So basically, if every 5 days I just kept resetting the bet, on average, it was 3/4 of 1%, 0.72 was the return. The median return is 0.79. So we look at two sets of statistics. One is the average, one is the median, because the average could get pulled up or down based on the outliers. So the median is like that return right in the middle. The other thing, what we want to know is like, well, if I just took the average of all the up moves and compared them to the average of all the down moves, how did that compare, right? Like, what is the bias? Is the magnitude? Because I know the probabilities of it going up and down, but what about the magnitude of the moves? The magnitude of the moves to the upside, the magnitude of the moves to the downside. So we see here the average of all the up moves, 2.5%, the average of all the down moves, 2.3%. So actually the bias is that from that perspective is more towards the upside. And what about really big extreme moves? Just give me the biggest move to the upside, biggest move to the downside in the last 4 years over a 5-day period. So the highest move over a 5-day period, 17.8%, lowest to the downside, 16.4%, right? So now I'm just painting a quick historical picture for myself of potentials. Now, if there's something else going on today that didn't happen in the past, you got to take that into consideration, right? I'm just taking it from the perspective, there's nothing that I could see that's different today than historically, and I don't have any other information, so this is the best information I have to go off. All right, so keep that in mind. You got to still take a look. If there's anything different today than from historicals, then you can't just count on this. You have to account for anything else that's in the news or any other information that you have. But really quickly, this kind of gives me now ranges, right? Potential ranges of upsides and downsides. Even if you're doing options, and you're looking at strikes, where do I think potentials are to the upside, to the downside on average? What do I think the probabilities of it going up versus going down? What are the extreme moves, on my wings? Like, how much am I risking, to the downside if I take a bet to the upside? So you see here, like how I'm floating around here. What is my potential downside? What's an extreme move to the downside? What's an average move to the downside? What's an extreme move to the upside? What's an average move to the upside? I'm starting to paint a statistical picture, so this way I could weigh my potential reward, right? My potential return versus my potential loss, or my potential risk. So I could start comparing them and adjusting it, right? So you could adjust it other ways if you think there's other reasons to think the probabilities of it going higher, or other reasons that you think the probability of it going lower. So this is a quick example of your top statistics. Here you kind of get a graphical distribution of returns, okay? And a histogram of returns. So if you see any like big outliers out here, tails, right? So you're looking at how often does it reach those tails. So you see just went like from 12% 2 times, nothing in between, bam, 1 time down up 18%. So those are your tail risks over here. Let's take a look at these.
Dave, real quick, we had someone who joined late. I apologize about this, but he just wants to walk through again. How, I know you did this right at the start, how you got to this page.
Okay, so I'm going to just use this page over here, and let's say you're on the home page. See this top menu, stocks, and over here, price return distribution under tools, or price action analysis. Yeah. It's called price action analysis. That's how I got to this page. So moving down, here's remember I chose rolling 5 days. So here are our stats, rolling 5 days and I'm using 4 years of data. The number of times, it was negative, 37.2. Number of times it was positive, 62.7. What if I wanted to see the number of times it went above 3.5% and below 3.5%? So above 3.5%, that happened 15.8% of the time. Below 3.5%, that happened 7.5%. So it actually, the upside moves above 3.5%. This is what it's telling me were twice as more frequent than the downside moves, 3.5. Okay. If we wanted to use 10%, we see though that downside moves above 10%, right, happen 0.7% versus upside moves, those extremes above 10%, only 0.3. So what is this saying? 3.5%, 2 times as many, right, as downside moves, upside moves, but the very extreme moves, 10%, that was twice as many as the upside moves. Okay, so you see those tails, those are really big tails to the downside happen more frequently. Okay, so if you're going out there selling those out of the money puts, there you have some statistics right there. Let's read these stats really quickly, and then I'm going to move on to another example. So here, this is a breakdown: positive moves versus negative moves. So we see here, like we saw before, 63% of them were up, 37 were down. Average up move 2.5%, average down move 2.3%. Median, the median to the upside was 2.06, median to the downside 1.54. This is the absolute average move, so this is just converting these to positive numbers. The high move, 17.8% to the upside, low move to the downside, 16.3. Then we have the standard deviation. So the standard deviation is also a measure of unit of risk, and that's important because you want to know, well, on the way up, all the up moves, what is the standard deviation? And on the way down, all the down moves, what's the standard deviation? So we see here that the standard deviation of the negative moves is greater than the positive moves, which means that when it was going down, it was happening faster, right? It happened at a faster clip than when it was going up, right? It's a standard deviation, how far away from the mean those moved around. So that's why you probably see somewhat of a negative skew in Microsoft. Imagine this is the total standard deviation. If we wanted just to see the top negative and top positive moves and the dates, so it could go here from March 5th, March 12th. Keep in mind, we're only looking at trading days. So if there's a weekend in there, it doesn't include that in the 5 days. So we could see here, this is when the biggest negative moves happen between these dates, biggest positive moves, which is interesting because the biggest positive move, followed not far behind the biggest negative move, right? So here's a negative move. I don't see anything in February here, but at least this top one. There's in March, October, 10.5%. So those are really quick insights into that return distribution. Okay, let's take a look at another way to. So these are rolling days. If you want to take out outliers, you want to switch to intervals. So the rolling days will be basically any 5 days. So it's like a moving average. So if there's a big outlier in there, it's gonna stay there for the 5 days, right, until it moves out. So it'll be in day 1 in the average, and day 2 will be in the average, day 3, day 4, day 5, and then it leaves. So if you use intervals, just say, give me 5 days, and then the previous 5 days, and the previous 5 days, it'll take out any of those big outliers. So we could redo it using intervals. And here it's almost the same stats. So not big difference in that situation. What about?
Hey, D, we did have a couple questions. Can I get them to you? Or
yeah,
Joseph is asking, is there a way to exclude 5-day periods that include ex-dividend days or earnings days?
you could exclude earnings days. So like, for example, here's Microsoft. This includes all the dates. Here, if you want to exclude earnings, you select it here and then rerun it. So you see here, these are our stats now, 66%, 0.72. So, so they changed a little bit. So that excludes any earnings out of there. We don't have an exclusion ex-dividend dates. Right now, we just have it for earnings. But I could put that in there if that's, something you wanted to exclude. But so far, that's the only exclusion we have. So let's keep it on there. So what if we did the opposite?
Can I ask another quick question?
Yeah.
It says, and this has to do with the tail. I think he's asking. So distribution of returns has a right skew. That's what this means, right?
That's what. Yeah. So you see here, that's the distribution. It has a right skew. Exactly. That's how it is. That, remember, that's over a 5-day period, right? So that's a 5-day period that I chose. It has a right skew. You can see it here, all right, between 0 and 5%. This is the histogram. So these are 111 versus 58. And the tails, and these are the tails. So you can kind of see in the histogram the tail. All right, and this is excluding earnings right now. What if you wanted to do only earnings? So let's say in Microsoft, we were interested in earnings. So I'm going to do this. Intervals around catalysts. I'm going to pick earnings dates. And then I'm going to set it. How far before earnings, how far after earnings. So let's say we're interested in 5 days before earnings to 5 days after. So we wanted to see that whole, 10 days, the 5 days before, 5 days after, 4-day, last 4 years. So this is how it looked, holding it throughout. So 75% of those days were up. This is the average move, average up move, average down move. These are your tails. So if we wanted to do, let's say, 5 days before and let's say 1 day before the last 4 years, can do that as well. So you can see here, not as good. So it performed actually better just holding it out throughout the earnings points. And this is how it progressed. You could see the lowest point over here 2 days before, so it tended to decline and then kind of went up that last day. So this is the average how it progressed. So remember, this is just around earnings, right? Because I put that catalyst in. You could do ex-dividend dates. Maybe let's see if it tends to rise before the dividend, right? So I'm going to put ex-dividend 1 day, 5 days before earnings to the 1 day before, last 4 years. Let's run that. So 56% of the time it was higher, 44% lower, for an average gain of 0.5, 0.5%. You could see here average up moves versus average down moves. So favored the upside. You could see the biggest upside move to biggest downside move. So this way you could kind of, let's see 5 days after the dividend. So the stats are the same. So I just extended it 5 days before the ex-dividend, 5 days after the ex-dividend. So we see here, slightly favorable to the upside. And these returns are including the dividend. But, nothing like that great as we saw in other circumstances. So this doesn't beat it, at least if we used any 5 days around Microsoft, I think it was 63% probability to the upside. This one, just around, if you just did around ex-dividends, 56%.
AD, Mike is asking, if we select a period of days, is that necessarily into expiration or just any period of time?
Well, this doesn't do this. This isn't with options. So this is any time. This is days. So this isn't looking at
strictly has to do with the stock.
The stock. Yeah, this is just looking at the stock. Yeah. So the expiration doesn't come into play with this. So this any days, you know, but when you set a catalyst, it'll have to be around the catalyst. So this one is anchored towards X dividends because that's what I chose, X dividends. Okay. If I choose earnings or so, any one of these. So if you guys are okay with the catalyst, I'll move down and let's say you just wanted to see weekly returns, monthly, or just a seasonality. So weekly is just a really quick way of just setting it. It's, you know, Monday to Friday. So 61% up, 39% down. Monthly returns, you could do it that way. So this is month, you know, over a given month, which is a much longer period. So it gives it more time to increase. 75% of the time it was higher, 25% lower. So that beats it out 3-1. This is the average move to the upside. Average positive move. I'm sorry, this is just the average move. This is the median move. This is the average of all the positive moves, average of all the negative moves, favor. So you could see here, favors towards the upside in Microsoft. So far, you guys are okay?
Yeah, looks all right.
A seasonality would allow you to pick any period, right? So any calendar period. So let's say I was interested, how did Microsoft do between March 1st and March 11th? All right, so that's what it's just set to now. You can change it. And I have it set here to 12 years. So let's take a look at that. So between March 1st and March 12th, it looks like here's, you know, the dates year by year. So you could see 42% of the time, Microsoft was lower in those periods, 58% higher. I'm sorry. 42% it was higher, 58% lower. All right, so that favors actually the downside. On average, it lost almost 1%. Here we see the average positive moves were 2.46, average negative moves 3.36. So favors a little bit towards the downside. And we could see here on the extreme side, the biggest positive move 5.3%, biggest downside move 4.2. And I think that is getting skewed, right? So we got that outlier because that's getting skewed last year, coronavirus. Is that where it hit around now, Will?
Yeah,
like
it was
really started selling off. So you
can
see here, right? So take that into consideration, right? You could take that out, but that's taken down the average, obviously, of all these, that 14.2%. Okay, so that's a seasonality way, and you could change these around. But let's come back to, I'm going to stick with the intervals. Let's take a look at a different way of doing it. I'm going to go back to the intervals here, and we'll keep it at 5 days. So let's just say I'm curious really quickly just to find out over a 5-day period in the last 6 years. Okay. So I'm going to do over a 5-day period in the last 6 years. How many times, so I have these new stats. How many times did it go up or down more than 4%? I'm going to do a quick check. And this is a really quick check telling me that below 4%, that happened 6% of the time in the last 6 years. So there were 18 observations that the stock fell more than 4%. There's 28 observations, or 9.3% of the time, that it was above 4%. Let's exclude earnings. So I'm going to exclude earnings here. Do the 4%. So you can see here it changed a little bit. Below 4%, when we don't have an earnings that covers that event, that happened 5.1% of the time. Above 4%, that happened 7.4% of the time. So that's telling me the frequency of times it went above these numbers. And I could just keep going. What about if I was interested at a 6%, you know, or 7% move? You could just do it that way. Okay. So that's how you use that quick tool in there. The next thing is, what if we want to compare it to something? Let's say QQQ. So I'm going to compare Microsoft to QQQ over the same time periods for 5 days, okay, in the last 6 years. So let's get the results. So which one did better? So here, Microsoft was up 61% of the time versus QQQ 63% of the time over those same 5-day intervals. The average return in Microsoft was 0.55 versus QQQ 0.45. This is the median return, 0.7 versus 0.75. So here, QQQ tended to go up a little bit more frequently than Microsoft over those periods, but on average, Microsoft had bigger returns. Average positive moves, 2.2 versus QQQ 1.9. Average down moves, Microsoft 2.1 versus QQQ 2. So to me, it seems like, a little bit more favored towards the upside in Microsoft. Extreme moves, biggest upside move, Microsoft 17.8, QQQ 12.7. Biggest negative move, 12.8 in Microsoft versus QQQ 12.5. So at least from the tails, that favors Microsoft to the upside. Okay. Now, what if I was only interested in the downside moves, right? I'm like, I'm okay with the upside, but what about when QQQ is down? What happens to Microsoft? Because that's what I'm worried about, that the market's going to fall, right? How do I check that? So over here, you could set those here. And here, this is the QQQ returns over that period. So we could use these slider bars like this, show me only when QQQ was down more than 2.8% or so forth. Or I'm just going to use this red one really quickly. Just set all negative numbers. So it's when QQQ was below 0 and reload the results. So here we go. When QQQ was down, right? When it was down, all these periods, there's 23% of the time Microsoft still was up in those periods, okay? 76%, it correlated to the downside with QQQ. On average, those periods, Microsoft lost 1.7%, QQQ lost 1.87%, so QQQ lost more during those periods, and on the median return as well. What about the average positive? Well, QQQ was never positive. The average of the downside moves 2.5%, QQQ 1.9. The largest upside move it did during that period in Microsoft, it was up 2.5%. The largest downside in Microsoft during that period was 12.8% versus QQQ 10.6. So then you kind of get a real quick snapshot of Microsoft's behavior when QQQ was lower. Now we could extend that and say, well, I just want to see more extreme moves to the downside. So when the market was down more than 3%. Okay, so you see the slider down more than 3%. Reload. So we could see down more than 3%, Microsoft correlated to the downside with QQQ on in all those situations. Okay, so when the market was down that much, Microsoft did, just got pulled down as well. We could see here that the returns were similar. So Microsoft, whether you're holding Microsoft or QQQ, the losses were very similar, 4.9%, 4.97. On the median return, it did a little bit better. The biggest downside move, was greater in Microsoft than QQQ, but not by a great deal, about 2%. So at least from this standpoint, if the market is down, whether you're holding QQQ or Microsoft, didn't really matter. You probably fared a little bit better in the Microsoft side of it, but it did get pulled down, dragged down with it, almost, well, every time historically when the market was down more than 3%. If the market was down less, let's just do 1%. So down 1% or more, there were a couple times Microsoft still ended up being higher. So from that perspective, you're better just holding Microsoft than the QQQ or the entire market. So that's real quickly comparing Microsoft to another benchmark. And you could do the same thing to SPY, right? You could do, what about SPY? So here's how it compares to SPY, 61% versus 63% over a 5-day period. Let's see all negative moves in SPY. Reload. So When S&P was down 24% of the time, Microsoft still managed to be up on the day. We could see, though, on average, the returns over all those same periods were pretty much equal. The biggest downside moves, Microsoft a little bit higher than SPY. So at least it wasn't down every time with SPY, but the returns there were equal. It's a wash. Let's go a little bit. Let's say 3% move in the S&P 500. Can't get it exactly. Let's do 2.9. So 2.9%, Microsoft still managed to eke out some gains during those periods. You can see here 11% of the time. We see here, on average, you're probably better off just holding Microsoft than SPY, because you see those average losses were 4.19% versus SPY 4.57. Max drawdowns 12.8 versus SPY 11.3. Very similar to each other. A little bit worse on Microsoft, at least to the max down move in there. And these are the stats of when we were talking about.
There's no way. Someone's asking, is there a way to see like all the components of SPY?
All the components of SPY in this tool, you mean, or just to see what all the components are?
Yeah.
Not in this tool. But you can, but I can show you how to go see.
Hey, D, real quick. You sound like you've gone underwater. I think the reverb has happened. So you will want to log out and log back in if you get a chance.
Okay, let me log. Yeah, let me stop. Let me come back in.
Hey, everyone. Thanks for hanging in there during these technical issues. We do have a lot of questions about watching the video. If you missed some, you can always go to the YouTube channel. All the video footage all the videos on file are free for you to access. We'd love it if you subscribe, but you don't even have to subscribe. But it's the MarketChameleon.com YouTube channel, and our entire history of both morning shows, little videos, and how-tos and webinars are all available on that channel. So a lot of great information. Do yourself a favor and get to the channel. I know I see the mayor from Naples, Florida is on mic, and I know he spends, 3-4 hours a day rewatching videos. He loves those videos, but it is a very useful channel. And if you did hear me, we do have a morning show that's live every morning, 9 a.m. on the YouTube channel. We do send out emails. There are little pop-ups that show up, and that is a great active group of chameleons who are on that show. And people talk about trading ideas, and it's a very useful episode every day. And here comes Dima back. Let's hear that sound, buddy.
Hey, can you hear me?
Yeah, sounds good.
Okay. But I'm going to leave it open now to questions, Will. If
All
there
right.
are any.
We did have questions as we were going. Like Mike asked, this is Mike from Tyler, Texas, on the YouTube chat. He was asking if a stock is currently at higher end of its IV rank or percentile, would we expect the potential range to be a little wider?
Well, that's what the implied volatility is saying, that the volatility in the next whatever days is going to be higher. So that's what the implied volatility is indicating, and that's why you would want to compare it to say, well, what is the implied volatility, letting me know versus what historically has happened, right? So, if the volatility, for example, is saying that the stock is going to move, in the next 5 days, let's say the volatility, the straddle's telling you that in the next 5 days, Microsoft's going to move 10%, right? 10% in the next 5 days. Well, now we could see in the last 6 years, well, how often did that happen, right? So I'm going to exclude it. And that's how you would want to say, like, well, implied volatility is telling me it's 10%. And I'm going in there and saying, okay, well, that's only happened, 0.7% of the time to the upside, 0.7% to the downside, 1.4. then I could start making my decision. Is it too high or too low? And of course, you want to take into account what's changed. So if implied volatility is very high and there's an FDA announcement or something coming up, that's different, right? You got to take that into consideration. So it's a way of you to compare, well, what are the options trying to say versus historically, how frequently, how often did that happen? So yeah, that's where it comes into play.
Very cool. We had a question on the Zoom, and right before we went underwater there, and there were some technical issues.
Okay.
I was trying to ask it, but he was asking, is there a way to see the distribution versus, like, he was looking for the entire market basically against each other. But like if you were to have SPY, could you see all the underlines of the SPY and see those historical price return distributions?
Yeah. So, well, the SPY itself has its own distribution, right? So there's components within it moving around, but the SPY, some of it will just offset, right? So the market itself will just offset each other. But if you just wanted to go and say, I just want to see what's in the SPY, maybe you could go to the SPY and you could go to the ETF info and look up the holdings. And these are all the holdings in the SPY.
Yeah, I think what he was maybe thinking is that he could see a list like this with all that distribution information, and there's nowhere to do that, correct?
Yeah, not for like the entire list of stocks all in one place. Yeah,
Great.
We don't have that.
Well, that list is certainly helpful that you can see the entire underline of the SPY.
Yeah, but you wouldn't be able to like pull out from here the holdings for all of them, because then you just have a list of 500 symbols. You'd have 500 of these, for each one. I guess you mean like if you wanted to sort them?
Yes.
Trying to think of what you wanted to do. It'd have to be like in a table. I got to think about that one if we could do that, but right now you can't.
Cool. Well, those were the two questions, buddy. Awesome job. 50 minutes of price distribution tool. Pretty good.
Awesome. Well, if there are no other questions, then I'll let you guys go.
Well, we did have a question. I put a link in YouTube and I put a link on the Zoom about the YouTube channel. That's where you go and get all the videos. The library is there. You can access any of the videos on the YouTube channel. There you go. And we do a live morning show every morning, 9 a.m. on the channel, which people seem to like, and it's super helpful. So awesome. Thanks a lot, Demon. Great job. All
right. Thanks, everyone. All right. Stay safe. Hope to see you guys tomorrow morning.
All right. Have a great night, everyone, and a great trading day.